What if the biggest hurdle to selling your home wasn't finding a buyer, but the bank that stands in the middle? Well, today we're diving into a way to sell your property that completely sidesteps that whole traditional mortgage process.
I mean, really think about that for a second. You're ready to sell, you've got a buyer lined up, but you just take the bank rate out of the equation. You become the lender. It's a fundamental shift, and it completely changes the game. So this approach, this method, it has a name, and it's really the core of the document we're looking at today. It's an unconventional offer for sure, called seller financing. And we're about to break down what that actually means. All right, so what are we really talking about here? With seller financing, you, the person selling the house, you essentially act as the bank. So instead of that one big check on closing day, the buyer pays you directly in monthly installments over a time frame you both agree on. You hold the loan, you collect the checks. But, of course, let's be real, you also take on the bank's risk, mainly the risk that the buyer might stop paying you back. Now, you'd think an alternative to the whole complicated banking system would be pretty popular, right? But according to our source material, these kinds of offers get shot down fast. They get a quick no right out of the gate. So the real question is, why? So yeah, what's the hesitation? In this next part, we're going to dig into the psychology and, the practical reasons why sellers so often just pass on this kind of deal. Our source document points to three main roadblocks. First one is pretty simple: misunderstanding. The seller just doesn't really get the potential benefits. The second one is super practical. They need that big lump sum of cash right away, maybe to buy their next place. And the third, well, it's just human nature, isn't it? It's way easier to stick with what you know, the traditional way. This quote from our source, it really pushes back against that whole comfort zone argument. It's basically saying that if a seller truly understood the financial upside here, we're talking tax benefits, more cash in the long run, then the only thing stopping them would be a lack of knowledge or a real genuine need for that immediate cash. It's a pretty bold claim, and it sets the stage perfectly for the benefits we're about to get into. So what is this big financial upside? This brings us to the core argument of the whole document, the 6 reasons it lays out for why seller financing isn't just some weird alternative, but maybe a great deal for the seller. Okay, let's unpack these first 3. First, the source claims you can sell at today's prices, which could help you avoid a potential market downturn. Second, you lock in that profit right now. But this third point, this is the real game changer. Your house goes from being a one-time sale to a steady stream of passive income, month after month. And this right here perfectly illustrates that idea, which the source calls convert your liability into an asset. See, with a traditional sale, it's a one-and-done deal. Boom, it's over. With seller financing, the property totally transforms. It's not just a house anymore, it's an investment, a cash-flowing asset that's working for you over time. And the last 2 advantages are just as powerful. First up, taxes. Because you're spreading those payments out over years, you could potentially lower your big capital gains tax bill. And second, speed and simplicity. The document argues that by cutting out the bank and its slow, painful underwriting process, these deals can close way faster and with a lot less stress. So, as we start to bring this all together, the whole argument really boils down to this one fundamental choice. Do you see your property as a liability that you just need to get rid of for quick cash? Or could it be an asset that can generate wealth for you long term? And this table just lays the 2 paths out perfectly, side by side. On one hand, you've got the traditional lump sum payment. Your profit is fixed, but you're at the mercy of the market. On the other hand, you've got ongoing income, a locked-in profit that could maybe shield you from market swings, but you have to step into the role of a lender, and you have to accept the risks that come along with it. And that leaves us right here with the final big question at the heart of this whole idea. What's actually more valuable in your financial life? Is it the immediate security of having all that cash in your hand right now? Or is it the potential for a larger, more tax-efficient profit that's spread out over the long haul? The answer, of course, is going to be different for everyone.